Okay, so today we're going to talk about two major things: the money market as well as what we call FDI, foreign direct investment. So why don't we first take a look of what the money market is about? Now, last week, we talked about the international capital market. So when we talk about the money market, it is related. Okay, the monetary system is related to the international capital market, but we are focusing more on the currency. Okay, the currency. I guess one of the challenges regarding international business is about changing from one currency to another. So I think one of you gave me this currency, okay? And if we want to do business with another country, or if we invest money in another country, we need to use that country's currency. The thing is, the exchange rate fluctuates. So that is one of the challenges to people who are involved with international business. So today we're going to talk about that. Now, talking about money. Now, what is money? Why do we need money? Why do we need money? Anyone? Why do you think money is required? Any comment? What is money? Now, money is used for three major purposes. Number one, money is what we call the medium of exchange. In other words, instead of using some eggs in exchange of apples, or some chickens in exchange of pork, we use money so that we don't need to find the person who has what we want and is willing to trade for us. It's very difficult for us to find such a person. If I have 3 eggs and I want to have, say, 5 apples, I need to find someone who has exactly 5 apples and is also willing to trade with me for my 3 eggs. But that would take me a long time to do that. If we have money, all I need to do is to use money to buy the apples, and the person, and then I may sell my eggs in exchange for money. So you can see money is what we call the medium of exchange. Also, money can be used as the unit of measurement. When I talk about, for example, the value of this calculator, I won't say, oh, the calculator is worth 100 apples, or this calculator is worth 10 pieces of meat. That's not how we usually say it, or how we usually measure it. We will say, oh, this calculator is worth $50, $30. So you can see money can be used as the unit of measurement. Last but not least, money can also be used as the storage of value. If we want to save our resources rather than saving it in the form of potatoes, apples, may not be a very good idea, because if you imagine you save the potatoes for 6 months, or you save your apples for 6 months, they may all become rotten. But if you save it as money, you can save it for years. So those are the three major functions of money: medium of exchange, unit of account, and storage of value. Now, I wonder if there's any questions so far.
No,
Okay.
Professor.
Okay, very good. Now, how about credit cards? Are they money? Do you think credit cards are money? Credit cards, in fact, are not money. Because even if you use a credit card to buy things, to buy different goods and services, at the end of the month, you still need to use money to pay for it. Now, unfortunately, some people, they somehow think that credit card is money. So they use credit card to buy a lot of things and end up not being able to pay back. And you may have heard of stories, some people need to declare bankruptcy because of overusing the credit card limit. So remember, credit card is not money. Now, even though cash is important, given it is the medium of exchange, medium of transaction, it is not considered to be very good investment because of inflation. It's good for us to put aside some money for future use. But if you want your saving to be growing in terms of the value, money is not a very good investment. That's why people, they buy shares, they buy government bonds. Some people may buy real estate properties as investment, because cash out of the inflation reason in the long run is not a good investment. Now just see if you can still remember that if a country with a currency that is getting weaker, what will happen to the price of its exports and the price of its imports? Does anyone remember that? Or is able to figure out the answer? If, say, the Canadian dollar is getting weaker, how would that affect Canadian export and Canadian import? Now, as the Canadian dollar is getting weaker, the Canadian goods and services will appear to be cheaper in the eyes of the foreigners. Because of that, the price of the exports would become lower, and that would increase the export. On the other hand, when the currency, say the Canadian dollar, is getting weaker, Canadians will find foreign goods to be more expensive because of the exchange rate. The price of the imports will increase and the overall import would decrease. One of the challenges to businesses who are involved with international trade or international investment have to do with the unfavorable movements in exchange rates. Because of that, businesses, they need to come up with different ways to manage the exchange rate risk. Now, to give you a little bit of the history of our international monetary system. After the Second World War, there was an agreement known as Bretton Woods. Basically, this agreement said the international monetary system should be based on the value of US dollar. And for one US dollar would be packed with a fixed amount of gold. However, in the early 1970s, US government found that they no longer has as much gold to support the US dollar. In other words, if all the people bringing back the US dollar bills to the US government and ask for the gold, US government didn't have enough gold to pay them back. So because of that, President Nixon decided to disconnect the relationship between gold and US dollar. Ever since, US dollar has been known as the fiat money, meaning that it's no longer packed with any gold or precious metal. So in order to ensure that people still have confidence regarding the currency, a lot of the countries, including Canada, has adopted a policy called inflation target. Basically, the Bank of Canada, the Central Bank of Canada, is saying, yeah, even though the Canadian dollar is not packed with any gold or silver, but don't worry about it, because we, the Central Bank of Canada, would ensure that the Canadian dollar will not lose its value in a rapid or drastic way. They basically say every year, the Bank of Canada would try their best to keep the inflation rate between 1% and 3%. So even though if you're now holding a Canadian dollar bill, you don't need to worry too much that the value of the Canadian currency would be gone overnight, because the inflation that takes away the purchasing power of the money is only in between 1% and 3%. A lot of other countries are following this kind of policies. Now, I know that some of you came from India. Does anyone know what is the inflation target of the Reserve Bank of India? Or have you ever heard about that? The inflation target of India, I think, is around 4.5%. So I wonder if there's any questions so far. Okay. So now, if the exchange rate fluctuation is a potential risk to businesses that are involved with international business, why don't we fix the exchange rate at a certain rate? Now, that may not be a bad idea. However, economists, they found out that in order money and capital to come in and out freely, the central bank can only choose to control the domestic interest rate or the exchange rate. But the central bank cannot do both. Most central banks, including the Bank of Canada, has chosen to control the local interest rate and to allow the exchange rate to fluctuate. That is why most of the time we see that the exchange rate is flexible, because most central banks want to control the local interest rate and let the exchange rate become flexible. Now, because most of the exchange rates are flexible, as a business, how can you manage the exchange rate risk? The exchange rate may go up or down. Now, sometimes some countries may intentionally lowering the value of the national currency. We call it devaluation. And usually devaluation, we're talking about a relatively significant lowering of the currency value. Or the country can intentionally raise the value of the nation's currency. Revaluation. Now, it's not easy for people to predict what the exchange rate of a country will be. The difficulties have to do with, number one, there may be unexpected events. Think about the exchange rate of Russia. Now, 5 years ago, we probably could not predict there was a battle between Russia and Ukraine, which obviously would affect the exchange rate of the Russian currency. Human error. No matter how sophisticated the forecasting techniques are, there are always different mistakes that can be involved. Or countries may change the regulations that end up affecting the exchange rate. All of these make forecasting very difficult. Now, there's an economic principle arguing that in the longer run, an identical item must have an identical price in all countries when the price is expressed in a common currency. We call that the law of one price. In the long run, there may be a tendency for that to happen. But still, it doesn't quite allow us to predict the short-run fluctuation of the exchange rate. Now, the purchasing power parity is about that the exchange rate between two countries' currencies should be equal to the ratio of their price levels. Evaluating the purchasing power parity, we are assuming there are no transportation costs of moving one good to another country. We are also assuming no trade barriers. For example, no tariff. We are also assuming that people are very rational about the exchange rate without considering the psychology of speculators. Again, like the law of one price, purchasing power parity allows us to have an idea regarding the long-term tendency of the exchange rate. But for short-term ups and downs, we still don't have a very clear idea what it may look like. Although there are still countries that adopt fixed exchange rate system, but as we have said a few minutes ago, most countries adopt the floating or flexible exchange rate system. Because of that, business people, they need to do something to hedge against the exchange rate risk. If we look at human history, there were a few major financial crises that have to do with exchange rate issue. One of the most significant one was the Asian financial crisis in 1997. And there were a few more of that. That happened in Mexico, Russia, Argentina, and so on. So I wonder if there's any question so far regarding what we call the exchange rate issue. Are you still there?
No, sir, no
Yeah.
question.
Okay. Do you want to have a 5-minute break? Do you want a 5-minute break?
Actually, we're good.
Oh, you are good. That means you don't need any break?
No.
Okay, how about Let me see. How about Satnam? Do you need any break?
Good, sir.
No? Okay, sure. So, now let's talk about the how we can manage the um, exchange rate risk. Now, there are few different ways for people to do it. They can make use of,
Excuse me, sir. I can't see this screen.
yeah, okay. You know what? Why don't we take a few minute break? Let's say a 5 minute break, okay? And then when you come back, I will be able to show you the um the PowerPoint slides.
Okay, Professor.
Yeah. Okay. The class will resume at 12:35. Okay.
Yes.
Hello, I'm back.
Hey, Professor.
Yes. Now let me go back to the slide. Now let's talk a little bit about the Asian financial crisis that happened in 1997. Now at that time, there were a few Southeast Asian countries. On one hand, they were trying to control the domestic interest rates of their countries. But at the same time, they try to keep their exchange rate stable, especially with the US dollar. So those countries like Thailand, Malaysia, Indonesia, South Korea, etc. Okay, they try to keep both the rates relatively stable. But as we have learned from the previous discussion, according to the concept of impossible Trinity, there's no way they can have both. Okay, so what end up is some financial speculators, they try to short those currencies. End up, those currencies went through a major devaluation, meaning the currency had to drop the exchange rate value in a very significant way. Now, the speculators were able to make money because of that. However, those devaluation lead to major economic crisis in those countries. So one lesson that the countries have learned from the Asian financial crisis is they need to have a more stable financial system, a better regulated banking system, and also if they want to keep the local interest rate, they probably have to let go the exchange rate. Now, one way that they can still influence the exchange rate is to have the foreign reserve, so that when the currency gets higher or weaker, they can use the current reserve to buy or sell the currency. But there's a limit of that. They cannot fully control the exchange rate. They can influence the exchange rate. Now, for business person, how can people manage the exchange rate risk? There are few ways that people can do. For example, by making use of the futures to lock the future exchange rate at a certain level, to make use of a forward contract, again, to ensure that the exchange rate can be set at a certain level by using options. Now, those are some of the ways people can do to try to manage the exchange rate risk. Now, up to this point, I wonder if there's any question.
No, Professor.
Okay, now I'm going to talk about the next topic, which is what we call the FDI. FDI. Has anyone ever heard of FDI before? FDI. Has anyone here ever
No.
heard of this? No? Okay.
Yes.
Yes. Yeah.
FDI, sir?
What is your understanding of FDI? What is FDI? Foreign direct investment. Now, what exactly does it mean? Now, we used to say that people can enter a foreign market by directly selling something to that market. This is what we call international trade. Now, however, there can be a potential problem to international trade because some countries, they do have what we call the trade barriers. Now, if you still remember, for example, a country, they can set up tariff quota to restrict goods or services to go into a country. So that one way a company can enter the market bypassing the trade barriers is by foreign direct investment. FDI. Now let's take a look at what exactly does it mean. Now, this is an example. You probably have heard of the automobile manufacturer Volkswagen. They do not only produce their cars and the parts in Europe, but then they have factories, they have production facilities in different parts of the world. They invest into different countries to produce their products, which is an example of FDI. Now, why don't they just, for example, make the cars and ship them to China? Isn't that easy? Why don't they do that? Instead, they actually have to invest in China to produce the cars there. Why do you think is the reason?
Can you repeat the question, Professor?
The question is Volkswagen, okay, you know the car company, right?
Yes.
They can produce the cars and then ship the cars to China.
Yeah.
But instead, they invest in China and then they produce the cars in China. Why do they do that?
This may be due to the laws of the government that you have to produce the product here.
Yeah, it's because of the trade barriers.
Yes.
If they directly export the cars from Europe to China, the Chinese government would tax the cars heavily. So in order to bypass the trade barriers, they invest into China, and very often they work with the local Chinese companies to produce the cars there so that the cars would be considered as made in China and won't be taxed because of that. Understand?
Yes.
Yeah, so that is one of the major reasons why FDI is so important. One of the major reasons has to do with FDI bypassing the trade barriers. Now, for the learning activity of this week, it is related to what I have just said. Now, there are two types of investment. Portfolio investment means the investment does not involve obtaining any management or control in a company. For example, when you buy the shares of Microsoft, you are one of the many shareholders, but you do not control the management of Microsoft. So this is called portfolio investment. Foreign direct investment is different. People do not only invest money, but they also gain certain management control. Now, there are different reasons why FDI is happening. It can be that companies want to bypass the trade barriers. It can be that they want to take advantage of the low labor cost. For example, if people find that, producing products in a particular country can be cheaper, then they will invest money in that country to produce the products. And it can be out of technological reason. You know that a certain country has a very strong technology, which you cannot find it in your own country. So you invest money in that country to make use of the technology there. Many governments welcome FDI because it helps to create jobs, and then it also means money are coming in the country. That's why nowadays, when we talk about international business environment, we don't only focus on export and import. We also focus a lot on FDI. Now, this is not the most updated, but it still gives you an idea how much money is involved with FDI on a yearly basis. Now, a lot of developing countries in particular, they like to attract FDI so that more jobs can be created, more opportunities can be created. On the other hand, a lot of multinational companies, they like to invest in different parts of the world because they want to bypass the trade barriers, they want to take advantage of lower labor costs, lower cost of resources, and also to take advantage of different technologies in different parts of the world. Now, drivers of FDI include, number one, globalization. Because of globalization, our world is getting smaller. It's easier for money to flow in and flow out. Number two, M&A. Now, not M&M, okay? M&M is chocolate. M&A means mergers and acquisitions, meaning that companies can combine together and form a new one, or that's called merger. That's called merger. Or one company acquires another one, that is acquisition. Generally speaking, M&A means companies are getting together. And that can involve FDI. Think about an American company, for example, acquiring an Indian company. That would be an example of the M&A with the FDI involved. Now, this is again another graph that shows the value of cross-border mergers and acquisitions. Now, there are two types of merger, or what we call acquisition. The first type is called horizontal. If we have two companies that are similar and they are forming a new one, for example, you can imagine you have two restaurants combining to become one. That is called horizontal merger. On the other hand, if you have two or more companies, they are not similar, but they are the ones that provide different supply chain functions for a common good or service, meaning they are involved with the different stages of production. For example, think about a company that makes movies, okay? And another company is the movie theater. So you can imagine a company like Disney producing movies, acquiring Cineplex, the company that shows movies. That is what we call vertical merger. Now, Disney does not acquire Cineplex, okay? I've just made up an example. So you see, for example, Disney and Cineplex, they are both related to movie industry, but one is producing movies, one is showing movies. If they combine together, that is what we mean by vertical merger or vertical integration. So far, so good? Now, market company means how strong the company is regarding its ability to manipulate the price of an item in the marketplace. The market power can be formed when a company is able to manipulate the level of supply, demand, or even both. So when vertical integration happens, sometimes it helps the company to increase the market power. Now, when we talk about foreign direct investment, a company will begin by exporting its product very often, but then later undertake the FDI as the product moves through its life cycle. Now, what does it mean by the life cycle of a product? For most of the products, their development is like the development of a human being. They need to go through the baby stage, the infant stage, and then the developing stage, so like an adolescent, and then the mature stage, and then the dying stage, just like a human being. So when we talk about FDI, that can be something like that when the product is in the new stage. It is produced in the home country because of uncertain domestic demand and to keep the production close to the research department that developed the product. When it goes to the maturing product stage, the company can choose to directly invest in production facilities in countries where demand is great enough to warrant its own product facilities. In the final standardized product stage, increased competition may create pressures for the company to reduce production costs. And again, FDI may help to reduce the production costs by investing in different countries to take advantage of lower labor and resource costs. When an imperfection in the market makes a transaction less efficient than it could be, a company can undertake foreign direct investment to internalize the transaction and to remove the imperfection. Especially, as we have said before, to bypass the trade barriers. And also sometimes if a company buys another company, it can then get the specialized knowledge of the other company, which is something you may not be able to trade easily in the market. The athletic theory says whatever seem the best or most useful things from many different areas or systems, rather than following one single system. Location advantage is about the advantage of locating a particular economic activity in a specific location because of the characteristics, either natural or acquired, of that particular location. Ownership advantage means the company ownership of special assets, such as the particular brand recognition, technical knowledge, or management ability. And internalization advantage is to internalize a business activity rather than leaving it to a relatively inefficient market, when it is better for an organization to produce a particular product in-house versus to outsource the work and to contract with a third party. You actually become more involved with the production when you directly invest in it. Now, foreign direct investment also involves different issues. Some countries would require you to work or to partner with a local business. For example, going back to the car industry of China, companies like General Motors or Volkswagen, in order to enter the Chinese market, because of the regulations, they have to work with the Chinese car manufacturers and to produce the cars together as partners. Sometimes the FDI may be related to what we call the purchase or build decision. In other words, whether to produce, purchase an existing business or to build a subsidiary in a foreign place from the group up. Now, production costs also have to be considered when you invest in another country. Customer knowledge. If you invest in another country, the local presence can help companies gain knowledge regarding the host country. It can be about following the clients and also following your rivals who may have already invested in the said country. Now, balance of payments, which have to do with the current account, that mostly involves export and import. But it can also be, but on the other hand, it's also about the capital account, that involves the purchase and sale of assets. Now, why do you think governments, they intervene in FDI? There are different reasons for intervention by the host country. If they want to control the balance of payments, to obtain resources and benefits, to get access to the technology and also the management skills and employment, they may then want to intervene as the host country. From the home country's perspective, sometimes they don't want money to leave their country. Because of that, they discourage outward FDI, meaning investment that leaves the country to invest in other countries. They try to discourage outward FDI because they see that investing in other nations sends resources out of the home country and lowers investment at home. Outgoing FDI may damage the country's balance of payments. Jobs may be gone because of that. On the other hand, not all the home countries discourage FDI. Some countries, they actually encourage FDI. For example, they may see that outgoing FDI can increase the long-term competitiveness of the country and the individual companies. They also see that some industries may no longer be relevant to the home country. If it is the case, why don't they encourage outgoing FDI so that the money would go into other countries to establish those, what we call sunset industries, because those industries are outdated anyway. So there's no point of keeping those industries at home. Encourage the businesses to invest in other countries and establish those sunset industries in those countries. Hi, Daniel.
Hi, Professor.
Hi, good to see you.
Yeah.
Yeah, just want to let you.
I came in so late.
That's okay. I just want to let you know that the video has been recorded and will be posted after the class, so you can always watch the video later this week.
Okay, another question. I have a question.
Yes.
Is there going to be a class next week?
Yes, for sure.
Okay.
Yeah. Okay. Good to see you.
Same here, Professor.
Yeah. So for governments, how can they promote or restrict FDI? For host countries, they can use different financial incentives to encourage FDI. For example, lowering or even to waive some taxes to generate low interest loans to attract investment to come in. They can improve the infrastructure for example, by improving the seaports, the roads, the telecom networks, the like highways, the electricity facility, so that they make their country more attractive to foreign investors. On the other hand, host countries can also restrict foreign FDI by, for example, setting some kind of ownership restrictions. Foreign companies cannot own more than 50% of a local company, for example, or they can come up with different demands. For example, a certain percentage of the production must be done locally by the local companies. There can be restrictions regarding technology, regarding import, export. For home countries, in other words, for countries that where the FDI comes from, okay, that's the home country. They can promote FDI, encourage money to go out by providing insurance on assets abroad, to provide loan guarantees or even the loans, to allow special tax treaties for money to invest in other countries, tax breaks on profits earned abroad, persuade other nations to accept FDI to make it easier for their companies to invest in those countries. Restriction may involve higher taxes on foreign income or sanctions that prohibit investing in certain nations. So you can see that both the host countries and the home countries, they can promote or discourage FDI to happen. Now, this is the learning activity of this week. I've got an article here. It's about a Chinese electric car manufacturer called BYD. I wonder, has anyone ever heard of this brand, BYD? It's like Tesla, but it's the Chinese Tesla, okay? It's a Chinese automaker that creates electric cars. Has anyone ever heard of this name, BYD?
Yes.
Okay. Now, recently, BYD is considering building assembly plants in Europe. Okay? Why doesn't BYD just manufacture the cars in China and ship them to Europe? Why do they choose to use FDI to invest in Europe to build the assembly plants there? Now, this is the question. Now, for this particular assignment, you can submit it as a team assignment. In other words, I expect you to work with your teammates, and only one member of your team is responsible to submit the work. But make sure you put down all the names of the team players who have participated in doing the work. Now, I wonder if there's any question.
Yes, Professor. So the whole team has to write only 200 words?
Yes, exactly.
And how many references?
Now, if you can find the information from the article that I provided, that you don't need any extra references or citations. But if you end up having to borrow ideas and information from other sources, then citations and references are required.
So we have to submit in the learning activity section?
Yes, but only one member needs to submit it.
Okay, Professor.
And make sure you put down at the very beginning, at the title page, who have done the work.
Okay, Professor. Thank you.
Yeah, I wonder if there's any question. So maybe I'll have a very quick conclusion of what we have just talked about this class. We talk about international monetary market. We talk about why money is important, because money serves three major functions. It's the medium of exchange, it's the storage of value, and it's also the measurement unit of value. And then we talk about in different countries, we use different currencies. So exchange rate risk is a major concern when we talk about international business. It may sound good that we have fixed exchange rate, but in reality, most countries choose to control the domestic interest rate without controlling the exchange rate, because practically it's impossible for a country to control both the exchange rate and the interest rate when you allow money to flow in and out freely. So as business managers, you need to manage the exchange rate risk, usually by the exchange rate forward or the futures or options. Okay, there are different ways that a business manager can do something to manage the exchange rate risk. And then we talk about FDI, foreign direct investment. Now, FDI has become more and more important because sometimes, especially if there are trade barriers, it would be very costly to export goods and services to another country. But if you use FDI, you invest money in that country, you bypass the trade barriers. Not only that, some countries, they can provide cheaper labor, cheaper natural resources, or even certain type of technology. So if you directly invest in those markets, in those countries, you can take advantage of them. There are two types of merger, right? Horizontal merger means the two companies that are similar are being merged and become one company. Vertical merger means the two companies, they may be related, but they are not exactly similar. For example, movie production company like Disney buying Cineplex. Now that would be a vertical merger. And then we talk about home countries and host countries. They can do different things to encourage or discourage FDI. And this is your learning activity of this week. Now, I know that some of you may wonder, hey, how about my midterm test? Now, this term, because we have a large class, right, with close to 50 people, it actually takes me longer to grade your work. But be patient, your marks will be ready soon. And once they are ready, I'll post the marks and you will be able to see them. Okay, that's basically it. And I wonder if there's any question from you.